Welcome back. In this lecture, we're going to talk about my favorite topic in options, that is option trading strategies. And to give us a little more room, I'm going to move my face off the side here so you don't have to look at my beautiful mug the whole time. So in this lecture, we're going to talk about four main types of strategies. One's called principal protected notes, one's single option with a stock, one's a spread, and one's a combination. So here's the four ways to think about it. There's four like families of option combination. So here's the roadmap. The first is one that uses a riskless bond uh, to set a floor for the payoff at zero, basically, right? Meaning, it caps the downside, if you will, by holding a bond. And it gives you some exposure to the upside because whatever money you have left over from buying a zero coupon bond at a discount, you can, buy the call option. This is called a principal protected note or a PPN. All right, so it gives you a floor plus some upside. So this is a pretty popular investment product. The second here is a combination of the underlying stock, right, and one option. And this is going to shape the natural symmetric exposure of a stock position, right? So typically stock's a linear payoff. Well, when we add some options to it, can change that linear payoff. So it can create a cap or a floor to the underlying stock. The third family here are spreads. So we're going to be using the same options, that is two or more calls or two or more puts, for example, to bet on different strike prices or maturities, depending upon if we have a bearish or a bullish or bet. And the last family here are called combinations. This mixes calls and puts, and really it's a bet on the underlying stock or whatever the underlying is, but we'll just say stocks, whatever the underlying stock volatility is, right? So it's sort of agnostic to taking a directional bet, right? And more about the underlying volatility. So keep an eye on what each strategy is really a bet on, because almost every payoff diagram we draw today can be, summarized as a bet on the level of the underlying asset price, the range of the asset price, or the volatility of that asset price. All right. So let's talk about principal protected note. The idea here is, imagine you have an investor that hands you $1,000 and says, "Look, I want some exposure to the stock market, but I can't end the year with my $1,000 being less than that amount. So how do we build that, right? Give them exposure to the market, but have a floor value." Well, easy enough, right? We can buy a zero coupon bond, right? Because we know zero coupon bonds sell at a discount to face value. Right? So we get that principal that's repaid at the maturity level. And then any residual cash between what the investor gives us and the cost of the discount zero coupon bond, then we can buy a call option, right? And so what's left over effectively then is, what we can pocket as the investment manager here. Okay. So how does the payoff work here? Well, it's pretty straightforward. Um, if the value of the market is below the face value of the bond, well, we know that the zero coupon bond is going to pay, its face value of $1,000, and then the call just expires worthless. No big deal. And if the share price is above, this sort of, the strike price that we established on the call option, then we get the difference basically between the upside. We get the gain, as it were, the share price minus the strike price. And so, um, the payoff looks pretty similar, except the sort of lower bound is the face value of the bond, right? So in the worst case scenario, we get the face value. In the best case, we get the face value plus, the profit from the market, the strike price relative, sorry, the stock price relative to the strike price. So let's make it a bit more visible here. Let's choose some numbers here. Let's say, as I mentioned before, the investor collects $1,000. I'm sorry, the issuer of the principal protected note collects $1,000 from the investor, and they buy a 3-year zero coupon bond at $1,000 face value. And let's assume the risk-free rate is 5%. So on a present value basis, this costs the issuer about $860 to purchase this, right? Which means they have, upwards or just under $140 in order to buy a call option at the current, share price. Uh, and when the issuer looks at the market, they see a 3-year at the money call option with a strike price of, in this case, we're making it sort of academically tractable by saying that the strike price is at $1,000. Um, and so that only costs 115 bucks. So the total cost to the issuer is $975. So we make about $24 for every note we issue, right? This is the whole business model, right? And the principal protected note um, is only going to be profitable to the issuer if they can buy the call cheaper. And that's what this line here says. If they can buy the call cheaper, then the difference between, right, the note price that they sold it to the investor for and the present value of the bond. And you can see the payoff function here works, right? So let's prove the investor payoff at, 3 years down the road. So if the share price is low, doesn't matter. Our bond pays a face value. The call is equal to 0. So even at the money, our floor value is $1,000. If the markets improve and the market's up, right, the share price is above at 1150 or 1300, well, that's our payoff. We get the face value plus the difference between the share price and the strike price. That is, the call option has value of 150 bucks or $300 respectively. So the only thing we really give up here by doing a principal protected note is that if it's on, say, an index, right, we're going to give up dividends because we're not holding the underlying. We bought a call option, and so we're giving up the dividends there. And of course, whatever the issuer's margin is in exchange for providing that floor, which in our little example here was about 24 bucks, right? Now, the great challenge to this particular, setup, is the following. So I start with this idea, when does the principal protected note work? Well, the product really depends on two things. Number one, interest rates and volatility. So if interest rates are high, well, then the present value of the zero coupon bond is going to be low, so it's going to be cheap, right? Which allows us to have a much larger budget for buying a call option. And more importantly, we'll have a larger margin, right? We can make more money each time we sell one of these. So the issuer wins in this case. The opposite is true in a world in which the interest rates are low because then the zero coupon bond will be expensive, right? So then we have a small budget for buying call options. It becomes uneconomic, and we don't provide the product. And in a high volatility environment, the call will be expensive, right? As sigma increases, right? This drives up the cost of the option. And so the amount we have to buy might not be enough, right? So our our ability to to buy, that option just kind of falls away, as it were. Um, now, the challenge is what you will have noticed based upon this information is that I'm going to come back here, is that sort of in the post-global financial crisis period, call it all the way through 2021, um, interest rates were incredibly low. So this principal protected note market pretty much collapsed, right? And issuers had to shift to different structured products. But since, the inflation that raged in the post-COVID era, interest rates obviously have been much higher and it has made these products a bit more viable, it turns out. But also in the post-COVID era, we've also seen volatility in the underlying assets themselves increase. So this is more of an empirical question, which one is dominating, and it's going to be issuer specific, right? Um, yeah, let's just give you the margin per note. We know this. All right, so that's principal protected notes. Let's move on to the second class of option strategies. This is when we combine a stock with the option that's written on the stock. Okay, there's going to be four main positions we talk about, and the four positions will basically reshape the payoff. So the most common one, and the first one we tend to talk about, is something called a covered call position. You may have heard of these that are actually highly marketed by financial product providers, especially now covered call ETFs. But, you know, they have some benefits and some negatives. But basically, the idea here is combining a long stock position and a short call, right? So we hold the underlying and we basically sell a call option above our current, level of the price. And the main idea behind this strategy is to create some sort of income. If you're a long-term investor, for example, and you're just sitting on an index of stocks, maybe you want to generate some income. So you sell some uh, premium, sell some options here to earn premium, but it does cap your upside to the long position. Um, Position B here is a protective put. So again, you have a long stock position, so you're invested in the market, but you're worried about the market pulling back. So you buy a put option in equal amounts, and it provides basically a floor value for your long position, right? It's like insurance. Um, and you still participate on the upside. Then strategy C here is a reverse covered call, which is exactly what it sounds like. It's a short stock position and a long call position. Um, and this is an idea where essentially you're shorting the stock, so you're taking a bearish bet. Um, but in case you're wrong, you buy some protection in case stock prices go up. So you buy a call to do that. And last here is a short stock combined with a short put, also known as reverse protective put. Here we're taking a short position in the stock, and uh, we're also going to earn additional premium, as it were. Um, Additional premium here on the short put position. So it kind of caps the short's gain if you're right, that is. So if the share price falls, you're capping your potential gains, but you're still taking a bearish bet and earning some premium in the meantime. Now, what you'll notice in these call out boxes here is that a combination of a long stock and a short call, reflects about the put call parity equation we talked about last time into, a short put plus a bond, a long stock plus a long put is equal to a long call plus a bond, and so on. Basically, anytime you're combining any one of the legs of a stock and an option, you're synthetically replicating the other side of the equation. So to show this in more detail, I'm going to draw pictures of each one of these particular strategies, and we'll go in the same order here. So let's start with a covered call. So a covered call strategy has this sort of payoff function here, profit function, I should be more precise. So we have a combination of a long stock, and so that's what this gray dashed line is. That's like a 45-degree line, right? It's got a positive slope of 1. And we also combine it with a short call position at some price above the current share price. So let's say, for example, that the share price was in and around right where you can see the 45-degree line intersecting the x-axis here. So let's say this is S 0 today, right? So the share price is here. And of course, you're just holding it for the long term. And so you want to generate some income. So what you do is you sell the call option and earn that premium, right? Whatever that premium is, maybe a dollar or two. Let's say it's a dollar, right? So this distance here is $1. Um, and so what this ends up creating, if you take a look at it, our resulting position when you combine the gray dash line, the long stock position, and the red dash line, which is the short call, you end up with this covered call strategy, which is the solid kind of bluish green line here. Well, what we have done now is synthetically replicate, right, a short put position, right? Which is interesting, right? We can use, a short put position plus the bond, right? That's the other side of the equation here. That's why it's higher than, it's above, if you will, this positive value line here. Draw a little picture here, right? It's shifted up by the combination of it being a short put and a bond. Um, And you might say, well, why would you want to do this? Well, I told you what the intuition behind it was, right? This is the most popular institutional option strategy by far. Pension funds, endowments, they use it all the time. Um, and if it's the case that you wanted, for example, to buy a naked put, or I'm sorry, um, you wanted to write a naked put, for example. Well, this position doing a covered call strategy might be cheaper to execute than actually writing a put. So um, something to keep in mind. All right, moving on to the next one. A protective put combines the gray dash line here as a long stock position, right? That 45-degree line. And then the red dash line here is the long put position. When you combine it, you end up with a protected put, which is the solid, greenish blue line there. Um, and so again, this is a strategy you would put in place where you're worried about the stock falling. So you buy a put, right? It acts like an insurance, and you pay the put premium. It's like a deductible, basically. It's like an insurance product. Um, what you'll notice here is that this is equivalent. This picture is equivalent, right, to a long call position plus the underlying bond, right? So a long call plus a bond. So it has the same payoff here, but it also might be cheaper and more capital efficient than actually just buying a call and a bond, right? Our next strategy here is the reverse covered call, right? So this, inverts the classic covered call. So instead of owning the stock, you're shorting the stock. So your stock, the gray dash line here, has a downward slope of -1. And your red dash line is the long call position. And if the share price, um, is at let's say it's right here where it crosses the strike, where it crosses the x-axis here. Um, we short this at this point in time, we might want to put on the call protection a little further out. Like if we're really worried about the downside, but we're willing to let it run a little bit, the downside from our perspective is if the share price increases. So then we would put on a long call position at this higher strike price. And so this is what the payoff function looks like. Essentially caps the stock, the short positions losses if the share price increases dramatically. So it's sort of a risk managed um, um, short seller's position here. And what you'll notice here is that the synthetic position here, the reverse covered call strategy, the solid line here, looks a lot like a put option, right? Again, um, that's, by design. And so this is another synthetic way to create a put option. Now, last but not least here, um, we're going to look at the reverse protected put. This one is similar in that it's a short position in the underlying. So you see the downward sloping gray dash line, which is a short stock. And it's combined with a short put position, which is the red dash line. So we sell one put with a strike at K, and we earn the premium, and that's why this line is shifted up um, by that amount. Basically, we get some premium here, and of course, it looks a lot like something we've seen before. We're taking a bearish bet on the stock, so because we shorted it. But we're willing to give up some of the quote unquote upside if the share price falls by, selling a put option to earn some premium in the meantime. And what we'll notice here is that the solid line here looks a lot like a written call position. Again, put call parity in action. And this is a bearish income trade. All right, so those are the four main positions there. And so I'm just going to revisit the put call parity condition because basically every single one of those graphs showed us put call parity in action. Anytime we have a stock with an option combination, you're going to have an option only twin, as it were, on the other side of the equation. All right, so a protected put looks something like this. Combination of the stock and the put is equivalent to the call option plus the bond. Um, Covered call, S minus C, is a short put plus a bond, and vice versa, right? So the implication here is that a synthetically constructed, option position will equal the real option position. Now, in practice, there might be a little slippage, right? So there are quote unquote limits to arbitrage because of structural frictions in the market, like execution risk, bid and ask spread margins, taxes, dividends, and things like that. So it can be the case that you can find a cheaper side to trade. As opposed to just say buying a long, put position, we can put on one of those synthetic positions instead because there might be frictions causing it to be cheaper, right? It's a micro structure question as opposed to a payoff question. All right, the third family here we're going to visit is something called spreads. This is a combination of two or more options of the same type. So like two calls or two puts. And we can do some payoff structures with those that are pretty interesting. The first one we're going to visit here is something called a bull spread. And as you can see from just the payoff here, it's taking a bullish bet, which is to say we're going to profit a little bit from a moderate price rise. So if we're sitting here, if the share price is in the middle here today, right, we can see that we have some room to gain here if the share price were to increase. And it's capped on both sides in terms of risk and or reward. So how do we construct this? Well, we can do it two ways. We can do it with calls, This is called a debit spread because we have to pay something up front. How do we do it? Well, we buy the call option with the lower strike price. And so we'll earn C1. Sorry, we'll pay C1. So it's a negative sign, right? For us. And then we'll write a call option at the higher strike price of K2. So we'll earn C2. So the net difference between these is going to be negative for us because a call premium at a lower strike price is going to be greater than the call premium at a higher strike price. So we'll end up paying, right, the difference between the two up front. The max profit from this position, as you can see visually here, of course, is when the share price is at or above K2, right, the higher strike price, minus the collective amounts that we paid for and received for the call premium. We can construct this differently with puts, and this when we do it this way, it's what's called a credit position because we actually receive income up front. Right? So what do we do? Well, we buy the put at the lower strike price, right? So we buy the put, the lower strike price, and we pay P1. We sell the put with a higher strike price at P2. Okay. And when we do that, well, for puts, if we sell a put with a higher strike price, it's going to uh, generate more capital than the premium we pay for the lower strike price. So we're going to end up receiving, right, the difference between the two up front. It's going to give us the same shape, but the different cash flow. And we're going to end up with a max profit again at the same place where if the share price is greater than or equal to the higher strike price plus any of the premium income. So this is a pretty popular strategy for basic options, income earning strategies with puts. In both cases, they are mildly bullish views, and it's cheaper than just buying a naked call, right? If I bought a naked call, well, then I'd only be paying for, I'd be paying the higher premium here. I'd get more upside exposure, but it would cost me, C1. At least when I sell the other call option at C2, it offsets, right? It offsets some of my cost. So that's a reason you might want to do these strategies, at least with call options. With put options, it's more of an income strategy. So here's a worked example for you. Let's say just the call options. So if the strike price was at, let's say the stock price is at 50 bucks, um, and it costs us, let's see, $2 to put this on, right? So let's say we buy a call option at 48 and we sell a call option at 52. So $2 to the upside, $2 to the downside. And the one that we bought cost $4, and the one that we sold, we earned $2. So our net cost, as it were, is $2 to put this on. Fine. Um, basically, per contract, that's $200 it costs us, right? So our max loss, of course, is going to take place when the share price is below the lower strike price. So that occurs, of course, when the share price is at $45. In this little example here, right, we see that at $45, our max loss is going to be at $2 per unit, right, or per contract $200 because the multiplier is 100. At the strike price, the share price of $50, well, that's where we put it on. Um, the option that's with the lower strike price is in the money by $2. The other one that we're on the hook for is not in the money, so our profit is zero here. And our max profit, of course, occurs when the share price is above the higher strike price of 52 bucks. So in this example of 55, the most we could earn overall is, $2 per unit basis or 200 bucks on the entire contract. So This is a one-to-one risk reward, um, strategy, right? And you could compare it. You would say, well, why would you do a one-to-one? Well, I mean, if you compared it to just buying the long call position, well, we would know our max loss on this one is, $4, which is double the cost, right? And therefore, it only breaks even when the share price gets above $52, right? Because the strike price is at 48, right? So that difference basically is equivalent to the cost of that. So it's a better risk reward trade-off in some or from a cost perspective than just a naked long call position at a strike price of 48. So it's a trade-off, right? It does cap the upside though. It does cap the upside. Hmm. All right, our next strategy we'll take a look at is something called a bear spread. And this is one that profits from a moderate price decline. It's just the mirror image kind of around the y-axis, if you will, the vertical axis of the bull spread. Two ways to put this on. From a debit perspective, meaning you're paying money up front, you can buy a put at K2, which is the higher strike price, and you end up paying, right, the premium, the higher premium, because the strike price is higher and you sell a put at the lower strike price of K1 and you earn that premium there. And so you end up paying, this P2 minus P1 here up front. So your max profit is going to take place when the share price is at or below K1, resulting in the difference, the value difference, of course, is the difference between the two strike prices minus your net payout to put on this position. Now, you can do this also with call options, right? With calls, we end up selling the call at K1, and so we earn C1, as it were. And then we buy a call option at K2 and we earn C2. Of course, we know that the option that we sold has a greater price with the lower strike price for call option. So on the front end, we receive the difference between C1 and C2. So it has the same shape again. The only challenge is we have to manage the early assignment on the short call, meaning when the share price crosses through and above K1, well, whoever we sold that contract to is going to exercise against us, right? They're going to put the stock on us for that price, which means we participate on the downside, as it were. But the max profit here looks exactly the same. The upside is we get cash on the front end, so it's a bit more attractive from a cash flow perspective. In either case, it's a mildly bearish view. And this position is, from a use case perspective, is helpful for hedging a long equity position against a potential sell-off, or you're sort of making a directional short bet, but we have some bounded risks. So this would be preferred over a uh, naked short on the call options, right? Because we're not being exposed to the upside moves in the stock price. And it also is preferred over a naked long position in a put option um, if we want to cap our minimum loss, right? In a put option, all we'll lose is the total premium, but if we earn some by selling this other put option, it gives us some assets here, some income, as it were. All right, so we had a bull spread and a bear spread, two ways to put them on. Um, This next strategy here is interesting from an arbitrage and a theoretical perspective. And it's called a box spread. I don't want you to dwell into it too much, but what's really cool about it is if you combine a bull call spread, right? So you put on a bull spread with call options, and again, from a picture perspective, and you can draw this for us here. All right, so that would look something like a bull call spread looks something like this, right? And then we combine it with a bear put spread, right? And so a bear put spread might look something like this. Well, you can see that the payoff here looks roughly like a synthetic riskless bond. In fact, in terms of the theory, uh, we have, let's see, this is K1, right? So K1, and this is K2, just to give you a graphical representation here. The payoff is going to be the difference between K2 and K1, right? This is basically a synthetic zero coupon bond that pays the difference between those two strikes at the maturity. So if the markets are frictionless and we're using European style options, it must be the case, excuse me, it must be the case that this payoff is actually just the present value of the difference between K2 and, K1, according to theory, right? So if you could buy this box, for example, for less than this value, right, then you can engage in an arbitrage because you're basically borrowing at below market rate, if that's the case, right? It's basically a synthetic, riskless, zero coupon bond. Um, Pretty clever. But again, I don't want to dwell too much in the specifics of it. I just want to give you a sense that you can combine all these utilizing put call parity to create the other synthetic side of it. Um, Another popular strategy is something called the butterfly. Now, this is the cleanest way to make a bet on a stock that you don't think is going to move much, right? That's the bet, that the stock just stays where it is, basically. And so here we're going to be combining three call options, or you can actually do it with puts as well, but we'll do it with call options. And we're going to use three different strike prices. So how do we do this? Well, we take a long position at the low strike price K1. When we do that, of course, that's going to cost us negative C1. Then we short two call options at K2, and that's going to produce two times, of course, whatever we call premium at K2, right? So that's C2. And then last but not least, we take a long call position at the higher strike price, costing us C3. So our max profit here is going to be essentially the difference between K2 and K1 minus the combination of our net debit here, which you can see here is going to be, 2C2 minus C1 minus C3, right? I'm just combining all these over here. And again, when you use this, when you think the stock's not going to move, it's going to stay within a tight range. And so um, you can earn the differences there. So this is a long butterfly. So basically, you're short volatility in this particular trade. You're betting the underlying stock will not move. And instead of, taking risk to the downsides, right? That is, if the share price goes up or way down, you're capping the potential losses there. So that's the benefit of this strategy. So let's look at a worked example here. Let's say the stock is at 50 bucks and we're going to use three strikes, right? So we typically will set these up at the money, meaning we have a symmetric strike price choice, one at $45, one at the money at 50, and then one out of the money at 55. And when we engage in this trade, here's the cost for us. To buy this first one, it costs us $6. We sell two calls, so $3 each, gives us $6, and then we buy one more call at the higher strike price for $1. So our net cost on this is $1 for the entire strategy, right? Times, 100 as it were, right? So $100 to put this on. The max profit is going to occur, just as a reminder, when the share price remains at 50 bucks. In terms of, the payoffs here, Let's take a look at that. And so we're going to have to evaluate the payoffs for different segments of the for different segments of the share price, right? Across those three different strike prices. So if we take a look at the areas in which the share price is at or below the lowest strike price, all the options end up out of the money. So the profit is just the max premium that we paid, so negative $1. If the share price approaches our maximum profit level at $50, which is to say it stays where it is, well, that first option is $5 in the money, the one with the lowest strike price. The remainder are equal to zero. So our max profit, the $5 minus the dollar we paid, is $4. Okay. So that's where we nail it. So 400 bucks would be our gain, right? If we nailed it. Um, The last bit of it here is if the share price is at or above $55, the highest strike price. Well, um, in the case of both of them, your max loss, of course, is the $1 for setting up the trade because basically all the gains from the lower strike price ones are offset by the higher strike price ones, except for the one that you wrote here. In this situation, it offsets this gain in this one. So it's all the same. The the um, the great thing about this strategy, based on this setup here, right? Our max loss is $1. Our max gain is $4. So this is a 1 to 4 payoff ratio, right? The risk reward bet on the stock just staying in the middle. So it's not, you know, it's pretty popular, around like index expirations, for example, um, index option expirations, um, right? Because indices don't move as much, say, as do underlying stocks. So it gives you kind of like a lottery ticket characteristic for taking a low volatility view. Um, so students often might expect this to be, the first time you guys see this, might expect this to be expensive, given the fact that we're looking at three different strike structures. But because we're shorting those two middle ones, it really pays for most of these these tail protections here. So it's a pretty interesting strategy in a low vol environment or in anticipation of low volatility. Now, another related strategy that I don't think it's in the textbook is called a condor spread. And basically, it looks exactly like the butterfly spread, except the difference is you're you're having a wider shoulder at the possible payoff. So you don't have as much high profit, right? So your typical butterfly would look more peaked. But if you're less confident, say, on where the share price will end up, well, then you can choose to spread out this flat, offset some of the high gain here for a likelier probability that the share price will be in between these other two strike prices, right? And this one's should be a little, relatively straightforward. We sell a call at K1, right? Sorry, we buy a call at K1, so that means we have to pay C1. We short a call at K2, so we receive C2. We short a call at C3, right? And then we buy a call at the highest strike price, CK4. So these are the cash flows, the premium that we receive on these, right? So this is very similar in construct. The only difference is instead of shorting two options at a middle strike price, we short two different ones in the middle, different strike prices. The earnings we get from the higher strike price, K3, is going to be smaller though than had we, picked one in the middle here. But conversely, the one at C2 or K2 here will have a higher call premium. Um, All right. So this tends to be, perhaps a bit more margin, margin efficient than maybe a butterfly spread, meaning we don't have to put up as much margin. we get a similar payoff. Now, there's a lot of retail platforms out there these days. You can think like Robinhood that market something called an iron condor instead. It has exactly the same payoff, but instead of, in this case, it's made with four calls. It would be a combination of calls and puts. It's effectively a bull put spread combined with a bear call spread. Right. So those are pretty popular in the retail markets. Um, Our next one here, just to give you a sense how many different, pictures you can draw with option strategies, is a ratio spread. Essentially, you're taking a long position at K1 and a call option, and right, and so that would cost you C1. And then you're taking a double short position at a higher strike price, right? So you're going to earn, the call premium at K2, so you're going to earn C2 as it were. You can do it any sort of ratio you want, and you can also build these with puts. Um, but the idea here is it's a modestly bullish bet between K1 and K2, with some confidence that there might be an upper bound to where the share price could move to. Um, and so, you know, um, this is a way to really double the premium, if you will. Why would anyone do this though? One is, it's set up as a credit trade because you're going to collect all this premium on the front end, and you'll profit if the stock kind of stays put, within this range between K1 and K2. Um, and or you can also be expressing a view that the stock's going to rot us modestly, but not, break out. It's a relatively sophisticated strategy, not typically used by retail traders. Last but not least, in terms of these spreads, is a calendar spread. This is a combination of, say, two options of the same type, two calls, for example. They have the same strike price, but they have different maturities. So, for example, the structure is you would sell a near dated option at some strike price, K, and you would buy the far dated option also at the same strike price. Both of them, of course, being the same, either both calls or both puts. The main driver of the profit on this is that if the stock stays near the strike price, then the implied volatility or the volatility is essentially, pretty small. So, um, this is a situation where the near dated option will lose value more quickly than the long dated option because of, time decay. The time value starts to erode more quickly for a near dated option than a long dated option. So you can see the shape is very similar to a butterfly, right? The peak is here at K. There's some losses in the wings here. Um, but the difference here is that the payoff profile really applies at the near, expiration, not the far expiration. We're betting on, you know, we're betting on that difference in time, as it were. All right, last but not least, we're going to talk about some combinations here. This is a strategies that combine calls and puts. And when we do that, it's a bet on volatility. So here's a popular one called a straddle. It's literally a long call and a long put at the same strike with the same expiration. And you can see visibly what the payoff is here. It's a bet on volatility, right? It's a bet that the share price is going to deviate meaningfully in either direction of the strike price. And so what's our payoff? Well, the payoff is going to be the difference between because we're taking both sides of the bet here, it's going to be the payoff of the absolute value of the difference between the share price and the strike price minus the cost of putting on these option positions because we bought a call and we bought a put. Our total losses, of course, is going to be capped, which is basically if the share price is equal to the strike price at maturity, then our max loss is pinned at however much we paid for it. Again, this is a pre-event. bet on volatility. Um, Typically, the way I've seen this used before is like before binary events, like for a biotech company waiting for an FDA approval for a drug, or an earnings announcement for highly volatile tech stocks, or maybe even a board vote on mergers and acquisitions decision, right? So these are situations that are kind of binary in outcome here. Next strategy here looks very similar. It's basically like we saw with the condor position. It's basically taking a straddle position, but widening out the lower dip, if you will, in case there's less volatility than you'd hope for. So instead of, a volatility crash, right? Instead of a volatility crash here, we end up in a situation where if volatility doesn't do anything, the share price stays right here, at maturity, then instead of having max loss down here in the straddle, our max loss is quite a bit higher, right? So that's kind of the main idea behind that. So how do we do this strategy? Pretty straightforward. You buy one put at K1, right? So you pay P1, and you buy one call at K2, which of course costs us C2. Um, so it's cheaper to enter because we're buying a call with a higher strike price and we're buying a put with a lower strike price. So it's cheaper to enter versus a straddle, but it does need more volatility, meaning the stock has to move much more to become profitable. And so our dead zone of max loss, while it's not as steep if there's a volatility crash, it is wider, these regions here. Um, so, when do we use this? When we have a view on volatility being high, but we don't have enough money to put on a straddle, right? Um, or we're concerned about vol being crushed, which would deepen losses in a straddle. Similar related strategies to a straddle are strips and straps. You can see that you can change the slope of the shape of the payoff if you have a particular bent on which way a binary outcome is going to go. So in the case of a bearish position, you would put on a strip, which is a combination of one call and two put options, right? So you're betting more on the downside here. A strap would be the opposite, where you're more bullish. So you've got one put option for downside volatility, and then you got two call options for upside volatility. And I'll sum this up with the following theoretical idea. Um, if you think about the payoff of any one of these strategies is just a sum of, say, what we call butterfly spikes. So imagine you have a butterfly that has really narrow wings. That would just be a spike, right? So we could create a butterfly with different strikes that are epsilon distance away from any strike price. Well, then the payoff, looks like this sort of spike centered on whatever your strike price is, K2 in this little example. Um, Now, if options were available at every possible strike price, every penny, right? You could combine many narrow butterflies if you want to approximate any payoff function that you wanted. Um, and so if you summed up all these, right, you'd have a sort of continuum of spikes that replicates any payoff function. And if you sum these all up, right, you get what's called the Breeden-Litzenberger Foundation. And what this is saying is that, if you take the second derivative of the call price with respect to the strike price, um, this is equal to the, density, if you will, of the underlying stock at expiration. It's equal to the distribution, right, of the underlying stock at expiration. So the option market doesn't just trade directionally, it can trade the entire shape of the underlying distribution, of the entire market's underlying distribution. So, bringing it back to today's lecture, we've got these four families, right? We've got bond plus an option, stock plus an option, spreads and combinations. These are, just convenient building blocks to explain the different possible payoffs. The real power is in the linearity that in that the options can span the entire payoff space. So any view about future distributions of the underlying can be expressed by combining them together. Um, and this is why options are considered the most flexible class of derivatives because we can effectively mimic any payoff that we want to achieve, um, assuming, of course, we have strike prices that are available at are within reason, at least across any of the underlying option chains. All right, so to wrap this up, what do we build today and what each family is really betting on? A bond plus an option, that principal protected note, that's a bet on the market with a lower bound floor. The main risk here is that if interest rates are low, the cost of the zero coupon bond is too costly to put this on, right? So it really depends on the economics of the issuer. So these are hard to pull off in low interest rate and or high volatility environments. In terms of our second class, which is combining a stock and an option, this is an attempt to reshape the linear distribution of the underlying stock itself, right? So we can cap the upside, we can protect the downside, or we can create any sort of payoff that balances around the put call parity condition. And here the bet is a directional bet. Okay. Our third type was a spread, two or three calls, two or three puts. So we could put on bull spreads and bear spreads, right? And these are bets on, a range of directional moves with some capped risks, right? Um, and we can also look at butterflies and condors and even calendars as a bet on the range that the stocks will stay within, right? So all of these are spreads that effectively say the share price will remain within a certain range, whether it's a bull or bear spread, butterflies, condors, or calendars. It's really a bet on a low volatility and they stay within a range. Combinations are the opposite. That is, it's a bet on volatility, combining puts and calls to create straddles, strangles, strips, and straps. These are pure vol bets and typically directionally agnostic. These are expensive to put on because you're buying typically both of these, but they can be the most powerful in terms of in terms of betting on volatility itself. So the big idea here is options are not just access to leverage, which they are, right? The multiplier being 100. They're rather the most flexible tool we have for shaping payoffs and trading the full distribution of the underlying stock. Okay. And when we come back next time, we're going to start pricing all of these options. We'll be starting with the binomial option pricing model before we move into the Black-Scholes-Merton model and the Greeks. So that will come in the next lecture. I'll see you then.